This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Okay, today on the show I have Patrick De Villiers, and Patrick is a managed futures pro, a systematic trader, and he is on Skype today with us from Cyprus, where I have not had a chance to visit yet. Patrick, welcome.
Hi, Mike.
How are you?
Very well yourself.
So why don't you? So as I just gave my very, very bad American pronunciation, let us hear the proper pronunciation of your last name.
If we were French, it would be De Villiers, but being from South Africa, it's pronounced De Villiers.
There you go. So South Africa to Cyprus, that's an interesting journey. You grew up in South Africa, though, right?
That's correct.
Yeah, I've not had a chance to go to South Africa yet either. But tell me about your early background. I mean, I want people to know from a big picture standpoint right now, Patrick is running a fund. It's a systematic trend following fund. He is scientific guy. It's all systematic. You know, there's no news, there's no fundamentals, but you know, that's the big picture. We're going to get into that. But I think it'd be really cool to kind of give people an idea of, you know, what was a 13-year-old South African lad doing back in the day?
Okay, so I've obviously had a listen to a lot of the podcasts that you've put on there, and like many of the guys that have been interviewed, I had absolutely no background or introduction to finance until I'd actually left university.
I would have 13. Forget about university. I want to know what you're doing at 13.
At 13 years, I was running around fishing, playing golf. Typical boy. Nice, lot of freedom. Just basically enjoying life at that stage.
Okay, was there anything early in your life, family influences, anything that was going to portend to an entrepreneurial type ultimate career? What was going on, your influences?
I think the entrepreneurial spirit came from my mom. My dad had been a lifelong employee of a large mining company called Anglo American. And my mom used to supplement the family's income with a whole lot of pottery, and she was teaching on the side. So my mom was always doing alternative businesses. I think the first thing that struck me from a financial point of view was that there was always money that had to be saved for annuities, retirement annuities that we had in South Africa. And this was a big sales pitch. These guys used to come to your door in the evenings, door-to-door salespeople, selling these retirement annuities to parents. They were either educational.
You remember this as a young guy.
I remember these guys coming to us because it was a major debate when I eventually convinced my parents to stop paying these annuities, to cash them in, take the stop loss, the 30% loss on the cash that they'd actually paid in already, and pump the money into my mom's interior decorating business. And that was my only influence that I ever received from the finance world. Barring that, I was just a typical teenager. As I said, spent most of the time outdoors fishing and playing golf. And never got into finance until I had to, because of the field I chose, and there was just no employment opportunities.
Well, take me into, so, you know, obviously you go to school and you get out of school. And did you have a degree in finance or?
Nothing at all, Michael. I mean, I left school, and I recall the registration process at university on the first day where you had a queue up. They put all the potential science students in a big hall, and on boards above everybody in the queues was all the various degrees. And right up until that day, I was going to do civil engineering. I wanted to build bridges. I wanted to build superstructures. And I noticed that it was just taking forever to be processed. But there was a very, very short queue on the far left, which was for physics major. And I thought, okay, well, that queue's moving quite fast. Now, I've been quite interested in physics. So I joined the queue, signed up for a physics major, and thoroughly enjoyed it. And I ended up doing experimental physics in superconductivity. So that was my formal education.
I should interject on the translation there, because unless some of my American friends have not traveled abroad, they might not understand that Q means line.
Apologies. Yeah, exactly. So it was a wonderful time at university. I spent a lot of time researching, and then I think what the experimental physics did teach me was how to analyze data and how to look for patterns in data, and that really was going to help me when we eventually started Neural Capital down the line. But on leaving university, I had two options after my master's, and it was to take up a PhD position overseas or stay and carry on the romance with my wife that I just met. And being the romantic, I decided to stay and try and look for work, which was a nightmare. Trying to find work with a pure physics degree in South Africa at that time was just impossible.
Well, put the date on it so people can follow along. Well, what time frame are we talking?
We're looking 1994. Coming out of university in 1994, having spent 6 to 7 years doing a hardcore degree, coming out with a physics master's was really difficult. Now, if you know something about South African history, we were going through quite a big political change in the country at that moment as well. So it was really exciting times for us in South Africa, but it was depressing from a job point of view, a little bit like it is today for youngsters coming out of university, unfortunately. But by pure chance, we had a family luncheon, and I met this young lady who said to me that she was working in an investment bank that hired all types of people, various different backgrounds. And in fact, one of the guys that she knew was he was an ex-medical practitioner, and he was working in their dealing room. And I said, all right, well, here's the CV. See what you can do for me. I said, I'm basically doing nothing at the moment. I'd appreciate any opportunity. And I was fortunate enough to be assigned to their graduate development program, where the whole aim of it was to take graduates from different qualifications and move you around the divisions in the investment bank until you sort of found out where you fitted best, whether it was corporate finance, trading, etc. I started off in the trading room and never left.
It's funny you mentioned your background and hooking on with an investment bank in that particular year, 1994. And I remember in 1994, I was interviewing in World Trade Center 7 with Salomon Brothers. And I remember some fairly snarky young lady sitting in front of me who was interviewing me. And she was looking at my resume, which did not say physics degree. And that was the primary reason that I was not hired, because that's what they were looking for at the time. Basically, I mean, I know it wasn't your plan per se, but there's no doubt that was at that moment in time, all the rage of that type of thinking individual was a huge, huge calling card, and that type of training at that moment in time.
Agreed. Even saying that, Michael, the South Africa did lag the rest of the world by approximately 15 years, just their banking industry, and the whole idea of hiring analytically minded individuals still hadn't taken off in South Africa. To this day, I don't understand what they saw in me, but thank goodness I got that introduction to the financial markets, because I really fell in love with them.
Well, let me jump you up though. So you're there for a while, and at some point in time you break off. Now, was your Neural Capital, which is just as some clarification, your current firm today is Neural Capital. That's your systematic trend trading style firm. But was that your first independent entrepreneurial venture?
Yeah, that was the first.
That was the first. So when you broke away from the bank, you and a partner hooked up and you guys started Neural.
Yeah, well, I'll give you a bit of background about the other co-founder, Brett. He was, I started to see a lot of benefits in some of the arbitrage models and applying science to our trading desk, and it was really paying off dividends in terms of profitability. And so I decided to not go the traditional route of hiring CAs or CPAs, you guys call them over there, finance degree individuals. I wanted to go the scientific, I wanted to go the engineering route, because I just thought those people think differently. They don't come with any preconceived ideas of how to invest and how to make investment decisions. So I find this young guy, and he's working in a state-owned minerals research lab. He's a chemical engineer. And at the time I hired Brett Fenter, he was in the process of studying his commerce degree part-time because he wanted to get into the finance world, but he thought he needed to have this commerce degree to be able to break through. And luckily, I was able to convince him to drop that nonsense straight away and just to concentrate on looking at the data and coming up with his own formulas and ideas of how to make money in financial markets. But anyway, we continued working on the desk, and I used to travel a lot for the bank back then, and I used to try and pick up a book every time I left Johannesburg Airport that I would read on the trip. And the one book that I picked up was something called The Predictors by Thomas Bass, I think the guy's name was. And it was this story of these Santa Fe students who go out and start to figure out a system at the blackjack tables, and they ultimately build this systematic investment house that, if I recall properly, was bought out by UBS. And that just struck a chord with me. I thought to myself, that's ultimately what I would like to do, is to build a system that could invest in the markets and take away all of the stress that I was experiencing running these large positions that were really just based on other banks and research with a bit of your own fundamentals added to it. And we started looking at, believe it or not, predictive investment models using neural networks. And that's why a bit of the name neural has stuck with us.
Well, neural was a big phrase back in the mid-'90s for sure.
100%. So to be honest, Mike, we never got anywhere. We spent 18 months of solid research into it. We just never really got anywhere with anything predictive. But the entrepreneurial bug with both of us was very strong. We eventually left in I think it was Jan and Feb of 2004.
But let me ask about the book, though. So you didn't get anywhere with the predictive aspect. Did that make you reassess what you had read in the book, The Predictors?
No, not at all. It just frustrated us that we couldn't get it right. I think we were arrogant enough to believe that we were smart enough to do this, but we were getting frustrated that we couldn't get anything right. We used to make a bit of money, but I mean, you just not enough to launch a firm or launch a business with, or even take it to the bank as a business proposal. It never changed anything. I think what it did do for us, however, is that when we left, we realized that we had to come up with something that was a little bit more robust than prediction. So.
And before you leave, though, I want to ask one follow-up about before you're breaking off to neural, because I saw a comment of yours online, which I thought was great. And I don't think average people necessarily understand this. And I think this is going to break into your big picture of neural. But the idea that when you're at a big house, you're at a big bank, that the performance is often based on the franchise that individual is working at. And why don't you explain that as a jumping off point to neural?
Well, one of your best podcasts that you did was with Tom Basso, I thought, because he talks about ego. So if you've been into many of the large banks' dealing rooms, and there's a lot of ego in there. You need that ego, you need that confidence, that arrogance to be able to trade well, to convince people that the positions that you are running are correct, that they're going to be profitable. However, it's almost a self-fulfilling prophecy, because what happens is you start believing your own nonsense. You start believing that the profitability that you're making is purely through your own genius, your innate ability to pick markets, to call the right fundamentals, etc. And often, more than often, what is actually happening is you discount the amount of flow that a large institution or bank provides to you onto your desk. And what I mean is just take a typical foreign exchange trader that sits on a large investment bank's trading desk. They are seeing two-way flow all day from large corporates that are either hedging or speculating all day, and they are just sitting in the middle watching the flow. So you get a lot of knowledge that if you took that same individual and put him outside without the infrastructure, without the systems, without the flow, he's completely blind. So when I mention that people often discount their own, discount the bank's franchise, that's exactly what I mean. You give your own abilities too much importance when you sit inside. And I've always said, if you really want to test your trading ability, whether you're a fundamental guy, whether you think you trade like Buffett, go outside of the institution and do it using your own money, and let's see what your emotions do to you every day.
How did we even get to the point that the two particular versions of trading could even get put in the same breath? Meaning the difference between sitting at a desk for UBS or some large bank today, JP Morgan or whatever, sitting there with the infrastructure of this massive, huge, billion-dollar firm is such an entirely different issue from the standpoint of trading versus your world today where you sit, frankly, alone, and it's up to your guile, your wits, your systems, your strategy to then extract alpha. How do we even get to the point where those two uses of the word trader are even remotely used in the same breath? I mean, it's just, they're not even remotely the same.
Well, Michael, I will add to that there's two types of trading. I mean, I've always built, when I was at the investment bank, I used to build my business around proprietary traders, people that would take longer term positions based on if they had a system or they had some sort of fundamental analysis of that particular asset. That was the one side of the business. Then your other side of your traders are what you call your market makers. Now, these are the guys that are continuously having to make prices to customers and clients of the bank that are coming in all the time. And to be honest, there is a specific skill set for both people. And often or not, in my experience, I've never found very good market makers that can go off and do longer term proprietary trading. So market making is a specialist skill set in itself, which I actually admire. It's a skill set which I personally don't have. And I would say, those guys are the genuine traders who can read the flow of the market and that. The proprietary guys, however, in my opinion, to give themselves a little bit more credit than they do.
I guess it's not necessarily a knock against the market making side. I think just from the average person that might be sitting out there, it's just the confusion between the two, and that there's such drastically different skill sets.
100%. And also take into consideration, we don't get the flash media coverage. I mean, if you came into Neural Capital's offices, it's a very, very quiet, peaceful environment. There's one or two screens that are giving us updates and giving us positions and stuff. And walk in, it's not fun for TV cameras. They want to go into a dealing room and see the guys banging phones and shouting and carry. That's what the world and the outside and the private investor believes traders look like and are.
So you're telling me if I ask you for your particular view about where Europe is going and what's going to happen, et cetera, you're telling me this is not part of the formula that goes into the alpha that you try to extract each day?
And not at all. I mean, I had another interview a couple of months ago, and the interviewer kept on trying to ask me my view on what I perceived was going to happen. And I don't know. And I've never met somebody who does know. I've met people who have very good guesses and they can give you good reasoning behind it, but no one knows for sure.
Let's talk about. Let's kind of move into some broad discussions of your strategy and how you approach things. And why don't you lay out for people? And I think everyone's always got their way of explaining it. But perhaps you're sitting down with a potential investor and they're a little unfamiliar with perhaps your trend trading strategy, your systematic type strategy. They're a little unfamiliar with it. And they hear you talking about not having an emotional bias or not dealing or not having an outside interference playing on you every day. If someone's unfamiliar with your world and you say those things, it kind of doesn't make sense. So how do you bring them into your world? How do you get them to understand when you say no emotional bias and no outside interference? How do you work them into your world?
Well, the financial investment world is a secretive place for the man on the street out there. So the first thing that you have to sit and do with the investor, even before you get to speak to them about systematic trading, trend following approach, is try and explain to them that we are not here to claim that we have any special ability, that we don't wake up in the morning, have a particular gut feel about a futures price, about any particular asset's direction. To be open and honest with them. And if your investor can accept your honesty, I think you've won them over. Once they've accepted your honesty, you can say to them, now, I most probably know as much as you know about what's going to happen on tomorrow in the world. From that standpoint, how do we create an investment process? So we try and explain to investors that if they had to look at asset prices continuously 24 hours a day, they wouldn't often see movement. They would see prices moving up and down and stuff, but they'd never they never appreciate the fact that things are moving from a certain level through a trend to another level of equilibrium. So we'll say to them, take a step back. And I always like to use dollar rand when we're talking to investors down in South Africa, because it is a currency that has significant trending prices followed by long periods of equilibrium price movement where it just sits in a range. And I'll say to them, last time you looked at dollar rand, where do you recall it was? And they said it might give me a particular level. I said, okay, well, when it moved from that level to the next level, it underwent a trend. It followed a trend. No one knows why it went there. And by the time it reached its destination, there were reasons provided by financial journalists, etc., and that. They may or may not be true. How do you capture the movement from point A to point B? And if we still have their attention, because believe me, Michael, a lot of people have switched off by then. But if you still have that investor's attention,
they still want to know why. They don't.
Well, they would prefer because they've been told by CNBC and Bloomberg and that traders know why it's going there. So they would prefer that we tell them why we know things are going to be moving.
You mean the agnostic view doesn't work?
100%. And LTCM, believe it or not, is still fresh in a lot of people's minds. People are still reading that book. So they don't want to hear black box. They don't want to hear systems. So you have to work on the softer side of systematic trading, the psychology, before you can even get into the nitty-gritty of why you make money, how you extract alpha from the market without having to watch the news all day, or not having to know the fundamental supply and demand curves of gold in the world.
Do you have some folks when you sit down that literally can't get that point A to B on the dollar rand, that they can't get past that?
Michael, we spent 5 long years in South Africa marketing to asset managers, some very, very intelligent people that we just, Brett and I used to look at each other in the meeting and go, there's really no point in us continuing because we are not going to get any money from this guy. We have to call the meeting short and follow up maybe later with something else. You just find that I always like to use this term. A lot of people have been Buffetterized. They just believe in this long only, this value investing, fundamental research. The guy has to know what's going on in corn. He's got to be a corn specialist. So these are obstacles that if I'm sure you've interviewed countless systematic traders. Everybody has to get over these obstacles when you meet investors. Once you get them on board, I always believe you've got a loyal investor for life, because you're never ever feeding him nonsense. You're never giving him a newsletter that tells him why you were down for the month. You were just down, and you're happy to report that you were only down X amount because your risk systems kicked in properly.
Yeah, what I'll never understand is if you even take it even to a simpler example, if you say something concrete. I mean, everyone knows about Apple's success in terms of products and price movement of their share price. You just tell people, say, look, imagine in hindsight that you didn't even know the name of the market, but you knew you could get on board something that was going to go from 50 to 500. When you say it like that, most people kind of realize, well, who cares if it's Apple? If it goes from 50 to 500, well, that makes sense. I can follow along with that. But a lot of people can't. It still strikes me like, what's going on in there? How do you get them to? This is the pivotal moment, okay? It's the pivotal moment, because if you can get people past the idea that you are kind of looking at the world that way, you are saying, I just want to know how to capture these big trends without going broke and possibly make money in the long run. And it's just a very difficult conundrum.
No, it's true. I think the difference with equities, we often joke that stocks are the market, because that's what people are watching every single day on their televisions. They watching it on their iPads. It gets a huge amount of coverage. Even if you consider, you have the foreign exchange market, which in terms of daily turnover dwarfs all of the combined stock markets of the world, but it just doesn't get the same coverage, because foreign exchange is not something tangible. You use Apple as a very good example there, because Apple is a worldwide product that someone sees when they walk into an iStore. They're understanding why the share price should move up. They know why RIM is going down at the moment.
Let me interject though. But if there was two charts on the wall, and yes, they understand Apple, but I think even if they didn't know what corn was, or they didn't follow the corn market, if you could show them a chart on the wall side by side, and one was an obscure commodity market and one was Apple, and there was no label on the chart, and they could see each one was a 10 bagger, I tend to think most people grasp that concept. Maybe I'm wrong.
I think you're right, Michael. We actually after we discovered some of your writing later on in the business, we actually I think you used the example in the first book, the trend following book. I can't recall, but you did use the example in one of your books. Am I right? Where you mentioned a curve, an equity curve with no name on it, and we've actually used that in a presentation. We've shown them what price movements are in coffee. It was actually a cotton trade. Without anything, and then we showed them the S&P index, and we said, which one would you prefer to be invested in? And you're right, when people look at it like that, but again, that's all hindsight.
Yeah.
Every investor is a great investor in hindsight.
Yeah. No, I'm not trying to say I'm right necessarily on that. I'm sitting here actually trying to think about this ongoing problem that people like myself and yourself have of trying to explain this. And I think one of the tricks, actually one of the negatives that I see, at least in the trend following fund managers, is I think there's so used to being perceived as less than, or so used to being perceived as in these pejoratives like black box, that they almost wear the scarlet letter on their lapel. And there's almost instead of being, and I can tell you're very confident, but you know what I'm saying? There's almost this kind of like, instead of like walking into the room and saying, this is how it is. Now, look, I know that doesn't necessarily work with investors. From my perspective, this is what I have to do. But let me jump you. I want to jump you into a couple things, though, about your strategy and some of the ways that you look at things. So one of the phrases that I saw that you used, which I think is great for you to kind of elaborate and expand on, as we're talking about a trend going from 50 to 500, there's no way to capture that perfectly, and you're never going to capture all of it. Why don't you talk about the idea of capturing 60 to 70% of the fat? and I'll let you kind of elaborate.
Okay, so we generally are regarded as a breakout trend follower. So we will look at a level where we will either buy or sell a particular asset price, and we would need confirmation of the fact that a trend has started. We also subscribe to the academic research that's been done that the entry point for a trend can be random. We firmly believe that you could wake up every morning, flip a coin, and decide which one of the futures contracts we trade you can go long or short, as long as you have an adequate stop loss and let the profits run. You'll make money. So once a trend is confirmed through our breakout level, we've obviously missed the beginning of the trend because it may not have been a trend as a hindsight view of the movement so far, because it might have just got to the level that you were going to enter and retraced back into its equilibrium level again. But the trend will formulate itself, and it will continue to move, and we'll sit and trail a stop behind it, because we just don't know how long the trend is going for. And our investment philosophy is to look for these massive outlying movements where trends actually exceed expectation, where prices go way beyond what people believe. And once it's reached this point, which no one knows in the future, the only reason that you know that the trend has exhausted itself is because it starts to retrace itself, and it starts to fall back down to the level where it may have originated from. And we then exit our position after we get confirmation that its upward or its downward trending movement has come to an end. So you miss the first 10 to 15% of the move, and you give back 10 to 15% of the profit that you originally had seen on that entire trending move. And that's why we always talk about taking out the fat of every single trend. We don't, it's near impossible to take out 100% of a trend, of a trend's move. But a lot of systematic traders spend time analyzing the exit, because your exit is substantially more important to your entry.
Let me ask, though, as we talk about outlying events, extreme events, outliers, perhaps even using the term black swan, and maybe you even want to talk about some of why that particular book inspired you as well.
Well, to go back in history and how the philosophy of neural changed and came about, we, after failing at looking at predictive modeling and predictive systems, we decided to base some sort of investment philosophy on our most successful trades that we'd had at the bank. And the one that we remember and recall most importantly was a fairly large Eurodollar position that was put on board in around 2000. And if you recall, it's after the tech bubble, Greenspan started to reinflate the balloon again. And we ran that position, and we just continued to run the position and run the position. It just kept on moving in our favor. And we were being frustrated by the fact that management kept on coming to us and saying, guys, we've got a quarterly review coming up, or we have a half-yearly result. Please cut some of the position. Volatility's too big. But the position just kept on running and kept on moving. And no one ever thought that interest rates were going to go down to, I think the 3-month at that point based out at 0.75. I didn't think it was going to go as low as it's gone now. But it had started at 6.25, so it was a dramatic move. And Brett and I decided that that's what we wanted to do. There weren't going to be many of these moves in financial markets, but when they do move, they move so extremely that you can capture quite a lot of profit. And that's what got the philosophy going. So to this day, we look and make sure that our system is capable of profiting from outlying moves, regardless of what the asset is.
Well, it's kind of, make the analogy to wildcatting for oil. So a lot of guys in America over the years would be down there in Texas, and they'd drill a lot of holes, and they get a lot of dust. But occasionally they hit that gusher, and it paid for everything.
Exactly the same concept. It's a typical venture capitalist concept. He's funding 100 small firms, and 3 of them become a PayPal. He's not worried about the other 97 that he's lost money on.
Yeah, and that's a difficult way, I think, for a lot of people, whether they're inexperienced new retail folks or high-end institutional investors. The idea of being wrong is not something that Western society has cultivated, because you are supposed to be right. You must have all the answers. There can be no wrong. You must know everything at all times. That's the way it works. That's success. Whereas you are outlining a strategy that really says, I don't know. I want to protect my capital. I don't want to lose my capital, but I don't know what's going to happen. And not knowing what's going to happen, I have to put myself in a position to benefit when the unexpected happens in my favor.
Michael, psychology of trading is so well documented. There's so many books that have been written about it. And it's an experiment that every single person can run every day of his life. And if you don't get the psychology right, if you don't understand what your emotions are doing to you on a day in and day out basis, when you're sitting with positions, watching P&L swing, you'll never actually be able to invest right. And I would say, when Brett and I started, we were fairly youngsters, and the most difficult thing for us to get right was the psychology, and the second most important thing was patience, because when you start trading, and particularly, I suppose, our psychology coming out of an investment bank was to hit those home runs. Everybody's just going to be multimillionaires overnight. Now, trend following and the way that systematic traders work is to take and to know that you're going to take a lot of losses. How do you ensure that the transactional costs on those losses are reduced, ensuring that you're not depleting your capital by taking those losses, and make sure that you're in the game for when the big winners come? Now, that takes patience, and it takes a lot of strong mental ability. And I would say those are the key factors when designing a system. And just as a retail investor, having the confidence in the portfolio that you've selected, whether you've received advice from somebody, but just having the confidence and sitting there and being patient and monitoring it, and if wrong, taking the loss, taking the stop, and changing.
There's a point here in our conversation, and I don't think I've said this in a podcast yet. I've thought about it a lot, but in the last 10 or so odd years, you make the point that trading psychology and all of these various biases have become the conversation du jour of these days. Except, here's the problem. So you look at a lot of popular books, Outliers, Black Swan, and people know this. And we look at behavioral finance. We look at the winners that got the Nobel Prize. I've always wondered, though, has anybody else except myself, folks like you, practitioners, has anyone noticed that the best case example of all of this behavioral finance, of all of this trading psychology, in fact, not only the best case, the only case that I really know about is trend following? How has that been obscured because it's like you read all these great insights on the behavioral finance side of things and the trading psychology things, and you would think the natural progression is to go, okay, here's how it all works. Here's what's going on with people. Here's how they think. And then you want to get to the point of like, okay, what's the home run here? Who's somebody who are the practitioners that are actually employing this understanding of human behavior for profit? And you get to that part of the book, and it's like, it just ends. It's like academic theory. It just ends. And you would think that these folks would at least have the ability to at least do a few Google searches and find out that there are some there are some people out there that practice this. I mean, does it ever cross your mind too?
Well, I just think trend following is not sexy. It's just not sexy enough. What do? We wait for things to happen, and when they happen, we jump on the bandwagon. And when they finish happening, we jump off. We it's just not,
But it does solve it. Modern media, though, has fallen in love with this behavioral finance thing. This whole idea of trying to understand how human behavior affects our decision making, that is something that major media has fallen in love with. But they don't seem to have fallen in love with is the idea of taking it one step further and saying, gee, who are the practitioners that actually have solutions for this?
Yeah, you're right. I think the way that trend followers approach their business, we don't do a lot of self-marketing, self-promotion
Well,
stuff.
That's not good.
It's not good. And I've recently I've been watching David Harding, and
he's very good at it.
he's very good at it, and sometimes I cringe and I feel sorry for him. And there was a recent interview where these, I think it was on CNBC, where these 4 interviewers were sitting on the chair, and they made him stand in front of them like a schoolboy.
Right. One of the best hedge fund managers in the planet, and they treat him like he's some rube off the street.
100%, and I still said to Brett, I said, "Are you watching this?" I said, I said, this guy, I said, how patient is he being with these guys? And I think what David Harding's doing for our industry at the moment, he's taking the abuse, if I can call it like that, for to get us out there, and I really appreciate that, because we do take a lot of abuse, but the counter to that, Michael, is I don't want everybody to be a trend follower.
Yeah.
I like the fact that the rest of the world wants to be long only, because it means there's more money for us. It just means that
before you go that direction, though, let me keep you on that example with CNBC and Harding for a second. What do you think is? I've watched. He's had 4 episodes on CNBC in the last couple of years, and each one is basically the same. And do you think they really don't know what he's talking about? Or is it the fact that if they acknowledge what he's talking about and show some understanding, because in the 4 interviews, and I've actually put the video back to back to back just as an analysis type thing, it doesn't, if they don't understand it at all, is that the issue? Or is it kind of like, we can't afford to acknowledge what you're saying has any veracity, or basically what we do for a living really kind of falls apart?
I think the latter, because then what you do is you're kicking mad money off the charts.
Yeah.
So that is my personal view. Though the interviewers at CNBC aren't idiots. If they definitely don't have stupid people behind the scenes that are researching the clients and that they have on the shows. So they know what's going on. I just believe that it doesn't say so much for the entire CNBC package of what you're trying to present, what you're trying to sell out there. Because, trend following, you don't really have a lot to talk about, Michael. Whereas when you're starting to do stock picking and talking about earnings and fundamentals and the current drought in the US that's affecting the corn price, there's just a lot of stuff to talk about there.
Well, that's true. And I've struggled with this for over the years, and I've probably calmed down some in my older youth, as I like to call it. But I mean, it forces an interesting situation for trend followers, because not only do you want to talk about what you're doing, and you and I can talk about a lot of the things that we are talking about, the trend following stuff. But if you let the other traditional ways go unscarred, if they're left unchallenged, meaning the question is do many trend followers really want to get into the battles, so to speak? And because let's face it, sometimes from a Zen standpoint of life, it's a little unsavory to have to get into a nonstop battle. But that is something, from my perspective, I think is probably a weak point of trend following and trend following practitioners, is that there's probably not enough gladiator behavior.
No, I agree with you. I take issue with all of the Buffett books that are out there, because I always maintain that Warren Buffett is hugely successful. His track record speaks for itself. However, retail investors believe that they can do what Warren Buffett does in terms of value investing, researching fundamentals and that, which is completely false.
Yeah.
At the beginning of every one of his books and every time he opens his mouth on TV, there should be a massive disclaimer. Please remember that Warren Buffett can get into any boardroom that he wants to. You can't.
You can call the president anytime he wants to.
Thank you. So, you have these books written and trying to tell private investors how to read financial statements, what to look in financial statements. Those aren't the decisions. Those are probably 10% of the decision that Mr. Buffett is making when he considers purchasing the shares in a company. There's a whole lot of other stuff that he gets into the nitty-gritty of that actual business. And these are the kind of things that worry me, because in the same way my parents were duped into buying RAs for so many years of their lives, going without things because they kept on making sure that they had that X amount of cash every month to pay for that RA's premium. It's just crazy. But unfortunately, Michael, we can't educate the entire world. It's just impossible.
Well, yeah, it is. But you know what? Maybe you have one of these unreachable goals and it keeps you motivated. I was thinking as you were talking about the comparison in my mind between David Harding appearing on CNBC and Warren Buffett appearing on CNBC. So on one side of the equation, you have this noted American investor, Warren Buffett, the grandfather, and he will appear on CNBC. And basically, he can appear on CNBC with a melted ice cream cone in his hand and say that the weather is really nice. And then everybody gets down on the ground and kind of like some kind of like weird cult-like bowing position. And they just go, the ice cream is good. The ice cream is good. Harding comes on and Joe Kernan basically says, so are you about to go bust like long-term capital management? I mean, it's this interesting contradiction. I love it.
No. It's amazing. What we should actually do, and just set this up maybe, is get David Harding to host a lunch and have people bid to have lunch with him. I wonder if he'd even raise more than $50,000. And it'll most probably be another trend follower who wants to talk to him.
Well, I have a feeling they'd both be very interesting. But I think perhaps what you would learn in a Buffett lunch would probably be some of the things that you're saying, is that he would probably, I think the interesting thing with Buffett is that he probably would not disagree with anything that you said. Okay. But I think the thing that's perhaps unfortunate for average investors is he could put his foot down and perhaps not allow the legend to kind of spiral out of control. Because I really don't think he's a dishonest guy or anything. I think he would agree with the things that you said, but the legend just seemingly has just turned into something else. So,
yeah, no. Kudos to him.
Listen, let me kind of, I can't keep you all day, but I want to kind of bring it back to discussing some of the big picture issues of your firm and letting people have a flavor for things. And why don't you also go ahead? Let's just, as a quick educational note, from my perspective, and you could tell me if you disagree, managed futures has become the industry term, the regulatory term to describe investment managers that often use futures for investing decisions. And typically, historically, the vast majority of traders in the, quote, managed futures umbrella are of the trend following variety. And I would also argue that the vast majority of success is in the trend following variety. It's not to say that there are plenty of guys out there doing shorter term strategies. I think that's just a historical note. So, but what I would like is maybe for you to kind of give the 35,000 foot view down from your perspective on why, a trend following managed futures style investment is really a requirement for every portfolio. I mean, not necessarily, just literally a requirement. So why don't I let you run with that, Patrick?
Okay, so I think every single portfolio, particularly in the current environment that we are in the world today, needs upside and downside protection. Now, it is well documented that managed futures, trend following in particular, because of its ability to pick up outlying movements, provides you with that downside protection. And what I would, just as an aside quickly, what I define as upside protection or upside exposure on your portfolio is something like a venture capital exposure, or potentially owning shares of biochemical firms that are doing research into new energy technology. Saying one of those things are going to kick off massive inventions, and it gives you that upside potential. However, as most people know, investors typically forget about all the positives in their portfolio, and they concentrate on the negatives. And times of financial stress, your portfolio, as was proven in 2008, there was a lot of correlation. All markets moved in a negative fashion, and investors were making massive losses. The only two investment types that didn't make was the short credit strategies, as Paulson was running, and obviously managed futures. I think 2008 was a breakthrough year for managed futures, and particularly trend following, because of the positive upside that we added to diversified portfolios then. So why do you need a trend following strategy? Purely because of its ability to not look for a profit target. It continues to run with a particular asset price, even when prices have gone way beyond the normal distribution that you would expect that price to move in. And as financial stress becomes more prevalent, so the managed futures portfolio that you have within your managed portion within your portfolio starts to protect you. We typically, because of the nature of the product, we typically tell the investors that we speak to that you need up to 20%. If you're a more aggressive, younger investor, we like to move you up to 20-25% of your exposure to the trend following strategy, because we don't only need financial stress to make money. Yes, we do make substantial profits during those times, but we generally tick along on above average yields and alpha returns, even in normal markets. So it is a strategy that every savvy investor should consider. Now, it was an expensive portfolio diversification in the past, because many of the managed accounts that were offered by the world's top traders required $500 or $1 million of initial capital. But there are a lot more ETFs that are coming on board now, funds that are starting up with enabling people to put $5,000 and $10,000 in. I think it's a strategy that everybody should try and find out about. Unfortunately, Michael, I don't think that your bulk of financial advisors globally get taught about trend following and managed futures and this type of downside risk protection, because they were just given typical Markowitz theory: diversify across your stocks, diversify in property and bonds, etc. So this is something that's going to gain momentum, and I think 2008, as I said, was very important for us.
Yeah, and I have I'm not making any kind of a prediction, but I think as everybody looks at the types of market movements that we have seen since August of 1998, and we're talking, nearly 14 years, I think deep in our gut, we all know, and this is as somebody who's not using fundamental analysis to make a decision, but you could be aware of the world. And it's pretty clear that from a societal, political, geopolitical, economic standpoint, chaos is seemingly ruling supreme. And there is no strategy that can put you in a place to possibly benefit when the unknown happens, like trend following. And I think you make the wise point also. It's not simply crisis alpha. It will also benefit from just big extended trends, and those could be on the upside. So even though my personal political view might be that we are not in the best of economic climates, if things turn around and equity markets just start zooming and commodity markets start zooming, trend following is going to do extremely well as well.
Agreed. I actually tweeted something last month. I said the Black Swan event in 2013 may be that the Black Swan never arrives. That the governments actually do buy us out of this trouble, and those are the kind of things that you need to consider. And as you say, equity markets may rally and commodities may turn around and price trends continue and no war in Iran, et cetera, et cetera. And the strategy, as correctly explained by you, gives you a diversified portfolio across a wide variety. Particularly if you're trading with, if you're investing with the large trend followers, the guys are doing 50, 60, and some of the guys 120 different futures contracts or assets. So you're getting exposure to every possible move of every possible asset there is in the world.
Yeah, and I think people need to keep that's a loaded statement, because some people might immediately think, maybe they only heard that part of our conversation. They'll think, well, how can these guys have some understanding to trade all of these markets? Well, and I think that's one of the great things about trend following. And you'd have to almost go back and re-listen to our conversation we've had today, Patrick, if they're not catching on. But it's the idea of looking at price action alone, and literally, it's not worrying necessarily about the name of the market. It's just trying to capture those unpredictable trends. And if you approach the world like that, and I think you can speak to this, you don't have somebody in your office that is analyzing crop reports or OPEC, do you?
Not at all. I mean, in fact, we've extended trend following to everything in our lives, because I think it's such a comfortable, stress-free decision process.
So you don't have the coffee reports coming in from South America on your desk on a daily basis? No.
Not at all. Not at all. We don't give the coffee importers enough business.
Interesting. So, well, listen. Let's sum up. And where can people best? And one thing I have to say though too, I did a podcast conversation the other day, and my associate who was on the other line was 90 minutes away from me, maybe 90 to 100 miles away, and the conversation was a pixelated, completely crazy thing on Skype. It just kept breaking up. You're in Cyprus. I'm on the west coast of America, and this is a fantastic connection. Watch, it's going to all of a sudden crap out right now. But anyways, I just want to make a note for that for people, that you're in Cyprus and I'm on the west coast of America, and this is crystal clear on Skype. So,
isn't technology wonderful?
Well,
I mean, that's also one of the reasons that managed futures and trend following is taking off. We have technology that enables us to access the exchanges directly, and it wasn't really possible prior to the 90s.
Yeah. Where's the best place for people to reach out and connect with you, find out more about your business, Patrick?
Always the website, Michael. So www.neuralcapital.com. Everything's there, the contact details, and there's a couple of links on your website as well, so guys will find us.
Okay. Well, great. Listen, we will talk again hopefully this year, and best of luck, and take care.
Thanks, Michael. It was great talking to you.
Absolutely. Bye-bye.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.